Hello, everyone. Welcome back to 3.0. And as today's topic suggests, the name itself, tokenomics. And we'll be talking a lot about tokenomics today. And who is a better person to talk about tokenomics than the founder of Dafi, Zain himself? Hello, Zain.
Hi everyone, really excited to be here.
Likewise. Zain, if you could tell us a little about your background.
Yeah, absolutely. My background has been everything from a technical market analyst in a few years ago to presenting at some of the biggest conferences for blockchain and universities as well for the technology. So tokenomics and finance in the world of blockchain is something that I've been really deeply interested in and have been publicly involved in the development of. Dafi is a project that I founded. It was initially a theory in how you could better create inflation and incentives for proof of stake models, and how protocols that are dependent on incentives to align users, and the whole game theory behind that, ways in which it could be completely revolutionized and improved, far more scalable, more decentralized, and better for long-term network participants. So Daffy is like something that we've seen in action and actually come to fruition and be developed. And other than that, I've spent a lot of time, researching other ways in which we can achieve exactly that, which is, better token economics in the world of blockchain.
That's cool. That's pretty cool. So, if we start off, and before we start off, moving into the details, would you explain the audience how you perceive tokenomics?
Yeah, I mean, tokenomics, or which is short for token economics, is the economics and laws and distribution of a finite or infinite supply of tokens that are used in a blockchain. So, in other words, every single protocol or certain applications on blockchains have their own standard token. This token has kind of like a different types of utilities, different types of life cycles in said protocol or blockchain application. And tokenomics are engineered, when done best, to attract users, attract network participants. In their best case, they're used for mainly two things, for bootstrapping, so incentives. And this is a way where applications can give out some of their tokens to the users who can come and use the platform and spur activity on the network. And the second best use case has been so far perceived as governance. So actually giving the token holders rights on the protocol and what is going to be built and what decisions that the decentralized organization takes. So these are the two most popular and the two use cases that we've really seen take off. I kind of see tokenomics as a way where platforms can kind of give a small stake of itself back out, and it's a way where you can actually share some of the network with its users.
Okay. So the key metrics like total token supply, circulating supply, and market cap, etc., perform an integral role in the basics of any DeFi project. So what
Correct.
basics an individual should dig into before investing? Like if I invest in a project with a circulating supply of 50% or what?
Yeah. You can do a lot of research in that. I think when it comes to the circulating supply side of things, fully diluted value, which is, all of the tokens, not those that are in circulation, multiplied by its price to get an overall valuation of that certain protocol or blockchain application, is very accurate. And it's now slowly starting to be used alternative to market cap. So, as you mentioned, with certain things that you need to do your own due diligence on. That's definitely one of them. So what we will probably see is more attention to metrics like that, and not just that. I would say many people looking at the holder distribution of where the tokens are. How much how much the treasury currently has, and other cool things that you can look at is the protocol generating tokens back from the market? Are they, generating revenue from the protocol side in order to, replenish the treasury? because remember, a lot of these token economics are finite supply. Maybe 1 million tokens, 1 billion tokens, whatever amount. But when they run out, which they can, there needs to be a way where the treasury is replenishing itself. So you need to be looking at protocols that have the ability to do exactly that, ways in which they can, keep the ecosystem and the life cycle alive.
Okay. So about the Dafi protocol, so how does it work? Its a rewarding mechanism and roadmap. Could you explain a little about Dafi?
Yeah. So Dafi is um, Dafi is essentially what we kind of look at as becoming this whole internet of staking. And what that means is we've been developing ways in which you can create incentive models to bootstrap, your network, which really benefit the long-term holders. The current issue with staking, and let's before we dive into it, explain what staking even is. Staking is ways in which projects can enable you to take some of the token from the network, lock them up from a period of time as a way of committing to that network and receive incentives, which are in the form of the token. So it's something that really started to become very popular from 2020, which was like the DeFi boom onwards. And
Yes.
with staking, it's a way where you can actually gain some yield from the network itself, rather than just buying and holding onto tokens. You can actually put them to work, and there's loads of different ways you can achieve staking. Whether it's liquidity staking, which has some risk with impermanent loss, or whether it's more single-side staking, which has lower risk, and there's even iterations of that. So with Dafi, what we've looked at is current staking has what we kind of refer to as staking 1.0, or primitive staking. The traditional way of achieving it is, you take your tokens and you lock them up, and you receive rewards in that token, and that's it. There's some cool features here and there, but that's pretty much all it is. Now the issue here is you're receiving rewards on how long you stay in the network, and not just that, but you're also receiving them depending on how much tokens you've staked. So the issue here is those people who come and stake a large amount will absorb all of the rewards from the staking pool. And also, if I see a project that's in its early stages, like infancy, or maybe it's in the bearish market, like we've seen in the market conditions right now, I don't really have as much reason to come and stake, because it's not going. The tokens are lower in value. So this is really an issue with old staking systems. They work very well in very bullish markets, but in the current market conditions, they aren't the best. So what we've been designing with Dafi is this product called super staking. Now, super staking is what you can look at as to be staking 2.0. And with super staking, essentially what it does is it distributes these synthetic forms of tokens to the stakers. And what it achieves is a few different things. One is you see these tokens accumulating, and they themselves can multiply based on market demand, not time. And why this is very important is if you look at how the traditional central banks work, they don't just set some arbitrary inflation rate without measuring anything in the economy. That's what we do in crypto and blockchain. We just set, okay, we're going to distribute 1 million tokens per month, and that's it. That's all that really goes into the thought process. And you can imagine how that's really, counterintuitive. Whereas with central banks, the way they affect monetary policies and inflation rates is they measure, they say they measure GDP and employment and economic growth and stuff like that. And in the situations where they don't measure their economic demand, which is like what we've seen in Venezuela and Argentina, etc., is when they're printing out money without that demand. And there's a lack of equilibrium between these two factors, demand and supply. And that's where you get hyperinflation. And the issue is we replicate this exact same model in the crypto world. We create hyperinflation in these digital economies that is now, we've seen in the traditional world. So why I'm mentioning this is because super staking achieves exactly this. It's a staking protocol that measures market demand and multiplies token supply, or token rewards in this case, depending on that. And the reason this is very cool is because if a project has super staking launched, and maybe they're an early stage project, or maybe it's in a lower demand phase, like a bear market, if I come and stake in that network, I'm putting some risk because it's a lower demand. And if that demand increases, I actually see my rewards split and multiply. And every second of every day, your rewards are multiplying in super staking. Maybe if the market tanks, if Bitcoin crashes, and we've seen this with projects that have adopted Dafi's super staking, when these past few months the market has crashed, automatically their staking system has reacted to it. And the way it reacts is using, Oracle feeds that measure market demand and price and all this other stuff. But what that means is that it's in sync with the market. You have a staking system that's in sync with the market, because when the market demand declines, what do you want? You want your network to go into protect mode. And what happens here is with super staking, immediately the inflation of rewards declines. And that's because the market demand has declined, and so should reward supply. So you have this constant harmony between the two factors, which is partially inspired by what central banks have done with different policies there, and just replicated in a decentralized fashion with the blockchain. And there's many other cool things with Dafi. Things like ways in which holders are better rewarded, because you earn tax from other users exiting and lots of other cool stuff. You can really dive deep into that on the Dafi website. So if you go to docs.dafiprotocol.io, you can really dive into that information.
Sure, the link of the website and everything would be in the description box. So anyone who is interested and wants to know more could definitely go to the website or even join the community. So
Yeah.
moving forward, cryptocurrency is either inflationary or deflationary, like you said, and many DeFi projects use inflation to reward the liquidity providers and yield farmers on their respective protocols. Moreover, they have an aggressive inflation schedule to keep up the annual percentage yields high. So,
Mm.
what measures does Dafi protocol take to reward the investors?
So we don't actually work with staking to be this arbitrary reward rate. What we actually do is we kind of have a range of rewards, and they may be more aggressive when the demand is higher, but they are less aggressive in terms of reward distribution when demand is lower. But it doesn't just mean that, okay, you should only come and stake when demand is higher. Then it's actually the opposite. You should come and stake when demand is lower, because your rewards will multiply when demand increases. So you're right, many yield programs, specifically for liquidity, you have to, as a project, have a very high inflation rate and a very high reward rate. And all this does is it exchanges a short-term solution with a long-term problem. The short-term solution that you're gaining is you're maybe gaining liquidity, or maybe you're gaining tokens being staked on the protocol as a project and a network as a whole. However, the long-term problem that the protocol has created is you're now going to have all these aggressive token rewards that are going to hit the market eventually. So with super staking, what we do is we kind of measure the market demand automatically. And if you choose to stay when the market demand is low, you see your rewards multiply. However, if you just come when the market demand is high, you don't get as much multiplication. An example where this would be very interesting is the whole Luna and UST issue. So as you guys have probably heard, UST was an algorithmic stablecoin built on Luna, and there was a huge amount of it that was being staked on Anchor. Now, Anchor was offering staking services, which was, I think, 20% yield per year on your UST. Now, a huge number of people had staked their UST because they were getting yield on this. Now, what happened is when the depegging of UST started to happen, people rushed to unstake their UST and sell. And that actually created like a spiral and a snowball effect where the depegging got worse and worse and worse. So Dafi Protocol actually made a proposal and an article on how this would have been prevented and how it could be prevented in the future. And the article basically dives into, if UST had created, a DUST or a super staking version of UST rather than what Anchor had built, it would have been a way where when the depegging started to happen, those who bought UST and stake could have got higher rewards than those who chose to, unstake and sell. They would have seen their rewards decrease. So it's a way where maybe it couldn't have been prevented entirely, but it could have been reduced in terms of effect, and it would give reason to people to come and participate when the depegging happened, which is really interesting.
Okay, that's I didn't go through the article, but I will surely go once again to read that. So
Definitely.
moving forward, tokenomics may seem new, like everything is particularly as you told in the past year, and but the underlying concepts are not. There are many existing examples in games, gambling, business, and finance already. For example, play to earn has existed in gold farming. So what impact does it create? What impact does it create that differentiates between them?
Yeah, it's a good question. I think a lot of the inspiration and foundation for tokenomics has been laid down by existing models. I mean, another one that I always look at is arcades. With arcades, you go and play different games, you earn tickets, and you use them tickets to redeem for
Yes.
prizes and stuff. And the only difference is that with tokenomics, these tickets they can be taken out of the arcade and they can be used in other arcades, or they can be sold for other arcade tickets, and you have this more interoperable universe. Because the key difference with tokenomics is that it's more permissionless. It's a way where this token lifecycle can be connected and interconnected with others. So, in other words, I could have a token from one protocol, and I can either bridge it and um, use it as collateral in DeFi, or um, sell it and buy another token for another project, and vice versa. So it's very cool because tokenomics, you have a lot more um, a lot more of a deeper meaning behind it, and that comes from the whole permissionless nature of what blockchain, crypto, and exchanges have offered. And I think that's a really big difference. Other than that, I think the foundation for tokenomics has already been laid down. And we've already seen that.
Okay. So, coming to an end, is there anything that you would suggest to the audience who is in economics and wants to transition in the Web3 and is going for tokenomics? What are the suggestions, or you could say a mindset that the person should have to give it a start?
I think Dafi has published a lot of material which makes it a lot more digestible and a lot more readable. And that's probably a good start. You can go onto the Medium page, you can go into the developer docs on the website, and a lot of that information is really, really good to read. And I think other than that, YouTube is, of course, like a really good place to learn more information. I think getting stuck in now is really important because, as the market's a lot more bearish, while many people may think optically it isn't great, the truth is that the best ideas are going to be built in this period, as they always have been. In every crypto bear
Mhm.
market, the biggest innovation has been slowly and quietly being built in stealth, and it comes out when a bull market comes. So here, stories are being written, and they'll be told when the market is bullish again. So really, this is a good time to get involved and just immerse yourself.
Okay, that's some great piece of advice, Zen. So there it is, everybody. Yeah, Zen just told us about tokenomics, about Dafi, and I see a very bright future ahead with tokenomics in the Web3 as if Web3 space is emerging, and the bear market right now, as Zen said, would be creating many innovations and biggest innovations, you could say. So thank you,
Yeah,
Zen, for being here today, and I hope to see you soon in person again whenever we get the
definitely.
chance.
Yeah, definitely. Let's make it happen.
Okay, thank you so much, Zen.
Thank you.